Hello, my name is Doug Richards. I'm a financial planner with Crest Financial, and this is our first in the Investing 101 series. Today, we're going to talk about equity investing. What are equities? The term equities usually refers to shares of stock issued by publicly traded corporations. Common stock includes voting rights to vote for directors and on governance issues for the corporation, where preferred stock includes income rights for dividends. Now, stocks are not guaranteed, and past performance may have no bearing on what happens in the future. In good times, stockholders are at the front of the line, and in bad times, everyone else is in front of the common shareholders. Over extended periods, stocks have provided investors with the greatest opportunity to stay ahead of inflation. There are three key considerations to make when investing in equities. First is the size of the company or its market capitalization. Next, you need to examine whether you're investing in a growth-oriented company or a value-oriented company. And finally, it's important to know where in the world the company is located. Market capitalization is a metric we use to evaluate the outstanding value of publicly traded shares. So if you have a corporation with 1,000 shares outstanding at $10 a share, it has a market cap of $10,000. This is a really, really small company. So looking at market cap, large cap stocks are stocks that generally have $10 billion or more in publicly traded value. Mega cap stocks have more than $50 billion in value. And usually large cap stocks have more consistent returns and less volatility than smaller companies. Pro tip, if you can sing the jingle, it's probably a large cap company. Mid cap stocks are between $3 and $10 billion of value. These are not household names, generally a little more risk than large companies, and historically a little more return to compensate for that risk. Small cap stocks are stocks with less than $3 billion and usually more than $300 million. For companies with $300 million or less, these are considered microcaps and are generally considered high risk. Small cap stocks have more risk than their large cap counterparts. However, if you step back and you think about it, there are only four things that can happen to a small cap company. One, it can fail. Small businesses fail all the time. This is not the best outcome for investors, however. Number two, it can carve out a profitable niche and remain small. Number three, it can grow into a much larger company. Take, for example, Microsoft or Hewlett Packard. These two companies were starting somebody's garage. And the fourth thing that can happen is it can be bought out by another company. So failure, not so good for investors. However, the other options are attractive. And historically, while the ride's bumpier with small caps, the returns have been a little bit better. Next consideration is growth versus value. And how do we determine whether a company is a growth-oriented company or a value-oriented company? One tool is the price to earnings ratio. This is a useful metric to evaluate this very subject. The price to earnings ratio is quite simply how much you would pay for $1 worth of earnings. So as an example, if a company has a price to earnings ratio of 25, you're paying $25 for $1 worth of earnings. Now, growth-oriented stocks tend to have higher price to earnings ratios. Relative to their peers, growth companies have above average profits or earnings and may be growing at a faster rate, hence the name growth company. Typically, growth companies reinvest their earnings back into growing the business, and dividends are small if they invest at all. At good times, growth-oriented stocks perform better, while in challenging market periods, growth stocks usually face more pressure. Value stocks are usually undervalued by some metric like price to earnings. In addition, maybe this is a company with a mature product life cycle, or maybe there's been a scandal that has pushed the value of the company down. Intrinsically, you're more familiar with value as a strategy because you like to shop for discounts and bargains. More mature value stocks usually pay dividends to reward their shareholders, and this income may play a significant role in the stock's overall returns. Value stocks historically provided more consistent returns with less volatility. There's a third possibility that a stock might not be a pure growth stock or a pure value stock, maybe something that's somewhere in the middle and maybe leans one way or the other as the economy runs through its market cycles. The third consideration is where in the world is this company? 70 years ago, 2/3 of the world's publicly traded stock was based in the United States. And today, it's just the opposite. There are far more investment opportunities outside of the United States than there are in domestic markets today. Developed markets refer to more established economies where the rule of law is well defined, and capital markets function much as they do here in the United States. You can think of Western Europe, Japan, and Canada as examples. Emerging markets or emerging economies can be thought of as economies that are catching up with the developed world. Examples here might include Eastern Europe, Southeast Asia, Latin America, as well as Northern Africa and the Middle East. These are all part of that emerging economy grouping. Now, emerging markets offer more potential for reward, but there's more potential for risk. While talking about risk for investing overseas, there are risks that you may not face here in the United States, such as political risk or social risk. When people are rioting in the streets, it's usually not good for markets. There's also currency risk. If you're invested in a Japanese company and the value of the yen goes down, all other things being equal, you've probably seen the value of your investment go backwards. Another term to be familiar with when we're talking about international investing is if you're looking at funds, mutual funds or ETFs, you may see the term global or international. Global investment funds usually include some portion of their holdings inside the United States, whereas international funds are exclusively outside of the United States. Sticking with international funds will reduce the possibility of fund overlap. Finally, studies have shown that a small to moderate portion of your portfolio held in foreign stocks can increase your returns and reduce your volatility by adding an additional layer of diversification. Markets don't march in lockstep. And so just because maybe the United States stock market's down doesn't mean things are down in Western Europe or South America. And so there's always an opportunity somewhere. Don't put all your eggs in one basket. So bringing this to a conclusion, equities or stocks have historically provided the greatest opportunity to grow your purchasing power relative to inflation. Owning stocks will have ups and downs, with many stocks losing as much as 40% of their value during the Great Recession. However, for long-term investors who stayed the course, they regained their lost value and then some. When building your equity portfolio, diversification matters, and you'll want to balance your holdings between growth and value with portions allocated across various market capitalizations. And don't forget to include something overseas. Professional, objective advice, incorporating your goals, time horizon, and risk tolerance can make a difference in your success as an investor. At Crest Financial, we help our clients with corporate retirement plans, foundations and trusts, business succession and executive compensation planning, personal retirement and estate planning, investment planning and portfolio monitoring, and risk management planning. Consider a different approach that starts with clear fees, clear services, and is clearly different. I've enjoyed visiting with you today. Again, my name is Doug Richards. I can be reached at doug@crestfinancialllc.com or at 541-868-0449. Thank you for your time today, and I hope you have a terrific day.